Welcome to Wealth Matters podcast. I have with me Prashant today. He has a Bachelor of Engineering degree with 16 years of experience in technology field. He's but now licensed as financial professional running a successful financial services agency. How are you, Prashant, today?
Doing great, Alpesh. How are you?
Good, thank you. Hey, Prashant, a quick question, and I come from technology world and moved into real estate, right? So why did you switch from technology to financial planning?
Well, I can bet the reason would be similar. Money is in the money business. I'm not putting down the technology world, but I loved what I did, Alpesh. But listen, at the end of the day, it's money. So, and I'm not just running behind the money. You need to like what you're doing. So
Yes.
that's one of the reasons. I found it's better. You can add a lot of value to people, and there we go. I did the switch.
That's the key. I think that's one of the important thing is it's not just about money. You got to enjoy what you do,
True.
right? And that was one of the reason for me to switch because I once I started learning about investing, real estate, etc. I thought, oh, I'm passionate about this thing. I love doing this thing. Why wouldn't I, right? So,
Absolutely.
so being a finance professional, what level of diversification people should look at for their money?
See, when it comes to the topic of diversification, there are so many financial vehicles that one can
Right,
look at. But what I tend to do, Alpesh, is instead of just taking the solutions approach, I try to keep it to the basics. So, two absolute areas that you have to do diversification. One is taxes, right? There are very many
right.
tax vehicles, but primarily they would fall into three: tax now, tax later, tax advantage, right? So
Mm-hmm.
you have to do the diversification at the tax level. That's number one. Number two, you need to look at is how you're growing your money. So in my opinion, there are only three ways you can grow your money. Number one is fixed, where you earn a fixed interest. Number
Mm-hmm.
two is in the variable market, where you can get an upper potential, but you got to be aware of the safety of your money. And the third thing is some sort of a mixed vehicle where you have some guarantees, so you don't lose money in a bad market. Now, what vehicle you're using, it's absolutely up to you, but the basics have to be cleared. So at least I would suggest those two levels of diversification has to happen.
Interesting. And where does life insurance fit into this game?
That's an interesting question. Life insurance, I would say, if you put up your financial house, life insurance is the foundation of your financial house. A lot of times people don't tend to look at a life insurance product as an investment vehicle, but today, because of the solutions and the advancements in the insurance products, there could be some of these vehicles that you can use as a growth vehicle or as a tax a deferral vehicle for your money. So life insurance products, I would say fit into the tax deferred bucket or tax advantage bucket, or many people use life insurance vehicle as an equivalent program to something like a Roth, where you defer the
Right.
tax, you can access your money tax free.
Yeah.
But on the investment side, you can earn a fixed interest in a whole life kind of a policy where you earn a fixed interest. There are variable insurance policies where you get a varying rate of
Uh-huh.
return on your insurance cash value, or these are called index universal life policies where there are guaranteed floors, and sometimes there are caps, sometimes there are no caps. So what happens is you can grow your money in multiple ways under a life insurance umbrella.
Oh, so I understood the Roth portion because I do have whole life insurance, right? And I understand how it's tax advantaged. It's like Roth on steroids because I can still control my money. The
Correct.
government is not looking at my money, right? But you
Yes.
just you just pointed to something else, index universal life insurance. And funny, I do have that as well.
That's
Even
good.
though even though most of the investors I talk to, they look at life insurance as a scam, but I have both whole and I index universal, right? So index universal is same as where we refer to as IUL, right?
That's a short form of an index
Okay.
universal life. Yes.
So that's pretty interesting because we on this podcast we have spoken about whole life insurance a lot,
Mhm.
but not much about IUL. So what is IUL or index universal life insurance?
It's a life insurance policy. When it comes to life insurance, there are two basic types of life insurance policies. One is temporary, which is called
Right.
as term.
Term.
The other one is permanent, right? So when it comes to the needs that a person has, that they'll want a coverage for a longer duration, maybe a 30-year term may not cut it. That's when you look for permanent life insurance policies. Now, index universal life policy is a form of a permanent life policy. Now, the basic difference, if you look at it, in an index universal life policy, your cash value, in the cash value portion of your life insurance, that money grows in a vehicle where you earn the returns according to a mechanism that the life insurance company gives you. Now, when I refer to the mechanism could be that you earn interest when the market is favorable, when the investment vehicle that you're investing your money against is favorable, you earn interest. Most of the times, if the investment vehicle is not doing favorable, if it is negative, if the market is down, you stay flat. You get minimum guaranteed 0%, or some policies give you even better than zero, 1
Oh,
or half.
really? Okay.
Oh, yes. Yes, that is called generally referred to as a floor. So what happens, you never go below your floor.
I see. So basically, index universal life insurance means it's tied to some kind of an index. It could be SPY, Dow Jones, etc. Right?
Yes.
So it's tied to stock market, and because we are talking about U.S. stock market, so I'm assuming it's SPY, Dow, or something similar.
There are multiple choices, and see, these companies have come up with various mechanisms. But be aware, most of the times, or rather, I would say, many of the companies may not be actually investing your money against that particular index.
Okay.
That's
That's
how they
interesting.
hedge, right? That's how they hedge. How do they give you a guaranteed floor otherwise, right? What
Right.
happens is a common investor can comprehend what is SPY doing, what is S&P 500 doing today, right? Versus they may not comprehend what's going on behind the scenes. Maybe their general portfolios, maybe their hedges against the options trading and whatnot.
Right. Yeah.
So one thing to understand is if anyone is investment savvy, your money may not be actually invested against S&P. You may not be buying S&P itself. And that's where a lot of people feel that, hey, this is very complicated. I don't understand it. Here's my question: if you get a writing, if you get a written contract saying this, that your money will grow according to S&P. If S&P goes up, you earn up to this mark. If S&P goes down, you stay flat, or you earn 0.75%. How would it matter?
Yes. If I have a contract, I don't care, right? And either way, I'm not trying to time the stock market, right?
Nobody can, right? Who has a crystal ball?
Exactly. No one can. People think they can, but so
So to answer your question, where does life insurance fit in? I'm sorry, where does life insurance fit in? If especially since you own an IUL contract, Alpesh, if you look at your policy cash value, where it fits in is you have some guarantees, right? I mean, rain or shine, your cash value would never deplete, right? Unless there are some riders that you're paying for, or there are any charges other than the typical mortality charges. But typically, generally speaking, your cash value may not be variable according to your investment vehicles or the stock market.
Interesting. So let's say, I'm a newbie and I want to understand more about IUL. And if I want to sign up, where should someone start to get more information about IUL?
There's a ton of information on the net, but I'll tell you, be very careful, because hey, internet is an open one. Anybody can write. And like you said, a lot of people think insurance investments are scam. I'm not saying they're wrong or bad. See, their experience is what they're talking about. But if someone wants to know more about it, there are very many companies who offer those things. I would suggest get in touch with a licensed insurance agent who sells the index universal life contracts. There are very many companies who are offering these kind of contracts. Now, in my practice, Alpesh, I'll tell you, whenever it comes to diversification, if someone understands the insurance aspect, because they say, right, buy the term, invest the difference.
Yes.
But guess what? Where do you invest the difference?
Exactly.
Right. So that may be an option, that, hey, invest the difference in an IUL. So I can always talk about, contact me, but they should always contact a licensed life insurance professional who can facilitate the IUL programs, because they are trained on it, and they would give you the details.
Okay, no, that does make sense. And let's say I contacted someone and I got started. What are some of the things one should look out for when they're trying to get an IUL policy?
Sure. Like anything else you would do, you need to look at the rating of the company. And the rating of the company, like Moody's ratings, S&P ratings, there are three bureaus who provide the ratings, right? You should look at the ratings. You should look at the claims paying history, right? Are they good at paying the claims? I mean, typically life insurance companies won't be as bad, but that's another thing you need to look at. Now, when it comes to an index universal life product as such, you absolutely have to look at what investment vehicles they're offering, what indexes, what index they're offering. Third thing you need to look at is, are there any caps? So you understand caps?
I do, but I would It would be great if you can explain it for my listeners, right?
Sure. Yes. So how the cap investment works is, let's say in an insurance company will say, okay, Alpesh, your money will grow according to S&P 500, but there is a 15% cap. For an example, what
Okay.
it means is if S&P 500 is growing above 15%, if S&P 500 does 17% in a year, you won't earn 17%. You earn only
Right.
15.
Right. Yep.
So the 2%, maybe, over and above what you earn, that would have been the company's profit, simply speaking. But at the same time, if the S&P 500 goes down 15%, they don't lose. Then you don't lose anything. So for capping you up,
Mm-hmm.
they're actually giving you the floor as well.
Right.
Why I would talk about the caps is because why do you want to cap up your growth, right? Why don't you want to get 100% of what the index would do?
Mm-hmm.
There are three strategies. Number one is a cap strategy, which I just explained. Number two is a participation strategy. What is a participation strategy? A participation strategy would say, hey, you get 100% participation in S&P 500. What it means, if S&P 500 does 17% growth, you get 17% credited.
Yeah.
Or maybe another company would say, hey, you get 80% participation. That means you always get 80% of what S&P does. Okay? Why? Because on the other hand, you always have a floor. And the
Yes.
third strategy is called the spread strategy. Now, the spreads are very common in mutual funds and stock market
Mm-hmm.
investment. The spread would say that, let's say, if a company says there is a 2% spread, what it means is whatever the index does, like in the same example, if the S&P goes up 17%, they keep 2%. So 17 minus 2, you get 15% credit. So when you're looking for an IUL contract, these are the things you need to look at. Why? Because why would you invest in a contract like that? For a longer term, right? It's a long-term
Uh-huh.
ramification. What you want to do is you get benefited over the period of time. So you want to make sure you're getting the best interest possible. Second thing, other than the interest earning potential, you also need to look at the cost, because all these life insurance
Yes.
contracts are going to have cost, right? Now, certain things, certain flags you need to look at. And that's why I would say if anybody is considering looking for an index universal life contract, at least get 4 different quotes.
Okay.
Okay. Why would I say that? Each company, see, I'm not saying any company is bad, right? Every
Uh-huh.
company has their own products. There's no one company as the best company. Each company
Right.
is going to have its advantages and
Yeah.
disadvantages. You want to compare those things, right? So cost, some people have the management charges. Some companies would have the management charges. There are very many types of charges. So when you get those illustrations, you look at certain pointers. You get an illustration, look at how much cash value would I have 10 years from now, 15 years from now, 20 years from now, 30 years from now. And then take that snapshot and compare with every company.
Okay. That
And the
makes
last thing
sense.
you need to look at is what average rate of return they're using for illustrations. Okay, is it fair to say that if you look at S&P, if you had been invested in S&P, what's an average return over 20 years, Alpesh? I mean, if I have to come up with an average,
8 to 10%.
8 to 10%. See, there is something called as AG49 rule. Okay, AG49. That rule restricts the companies, especially who sell the IUL, to run the illustration at a maximum rate. Okay,
Uh,
opinion that is 7.4 as of now. Okay.
okay.
So if they're running beyond that, first of all, they're not doing the right things.
Oh, yes. That's a red flag right there.
Be careful. You got to be careful. So those are some of the things I would say we need to look at.
Okay. And so when you mentioned about getting 4 quotes, do you get those 4 quotes from same finance professional, or should you go with different professionals and compare the quotes? Does it make any difference?
Uh, it wouldn't. So the thing is, see, the insurance companies have their own software, and if you
Okay.
key in your age and the health rating, all of their, I mean, any company would run it according to their underwriting guidelines.
Mm-hmm.
So if you're a finance professional, let's say me, I don't work with one single company. I work as a broker. So
Right.
I can run 4 different quotes and give to my client. But let's say somebody's finance professional, they only work with XYZ company. Then I would say that, hey, you know what? Reach out to others, right, and get the
Right.
quotes from them.
Right. So, so when they're working with just one company, is that fiduciary or not? Or that's how they are?
The topic of fiduciary is a little
Yeah.
complicated. In general sense, if you ask me, fiduciary means I need to think of you as a client and
Right, exactly.
not
Yeah.
only my commissions.
Not try to sell annuities on what, whichever does not make sense for
Right.
that particular client,
Right.
right?
So technically, every one of these people, rather everyone who is in sales, needs to act as a fiduciary.
Right.
Now, can we expect everyone to do that? I can't
Yeah.
comment.
Yeah, no, that's good. Anything else you want to cover about IUL? Because then I want to compare IUL to other products as well.
Sure. The other thing that has become very popular these days, and if I'm not wrong, pretty much after 2013, Alpesh, all these companies, or rather most of these companies, are offering more than death benefit. Let me explain you specifically what I mean. Is there's something called as living benefit these days.
Okay.
See, lately, if you look at the trend, most major bankruptcies are happening because of sudden illnesses.
Uh-huh.
Okay. I think in 2017, it was somewhere about 62% of the bankruptcies happened because of some sort of,
62%.
that's what
Ooh.
I've read, right? Why? Because the health insurance plans may not be as good as they used to be, right?
Right.
Deductible plans. So what is happening if you come across any sort of chronic, critical, or terminal illness, right? If you don't have LTD, STD, long-term disability, short-term disability, then
Mm-hmm.
what you have to do? You have to deplete your savings.
Yeah, you're done.
Saved up for your retirement, you're going to depleting your savings, right? Because you can't avoid it. You're alive. And the thing is, you have life insurance, but you're not dead yet. The insurance company says, dude, you're not dead yet. We can't pay nothing.
Yeah.
In that case, these living benefits will come handy. I haven't seen as much of a comprehensive living benefits kind of offerings in other types of policies. But in index universal life, if somebody's shopping around, you should look for the three categories. So it should have, this is called accelerated death benefit, by the way.
Uh-huh. Yeah.
Accelerating the death benefit in advance of dying. It's like being the beneficiary of your life insurance contract while you're alive.
Mm-hmm.
So three accelerated benefit riders you should look at. Chronic illness. What is chronic illness? If you're unable to perform 2 out of 6 daily activities: bathing,
Right.
dressing, incontinence, eating, transportation. Right. Second thing is chronic, the critical illness. Heart attack, any critical illness. And the last thing is terminal illness. If you have less than 2 years to live, cancer, right? Terminal cancer.
Yeah.
Those cases, you can accelerate your death benefit. If you have $1 million policy, you can take 200 or whatever percentage the company allows you. That is one thing that has made these IULs very, very how do I say? I won't say lucrative, but it has made more sense to go for these
Right.
contracts because it may come handy in your later days.
So these contracts you are referring to, are they same as something called long-term care rider, LTC or something? Because I have that in my IUL policy.
Do you do? The definitions is what makes the difference. LTC, the kind of rider that you have. I also have a policy from a company that has an LTC rider, long-term care
Right.
rider. The definition is what you need to look at. My definition says if I come across chronic, critical, or terminal illness, I can take 4% of my death benefit. So I have $1 million death benefit. So 4% of that I can take on a monthly basis.
Wow. Okay.
Right? So $40,000 I can take out, but that LTC, long-term care rider, so their HIPAA rules would apply. So how much money I'm taking, there may be tax implications.
Right.
Versus the acceleration of death benefit, it's basically death benefit that you're advancing.
I
So
see.
speaking, the
Okay.
death benefit is tax-free. So the
Yeah.
tax implication is what I would say would be
Right.
the difference there. Yeah.
Okay.
But I won't say both would be similar. Both are same. No, the definitions would make the difference.
Okay. No, thanks for sharing about that. So, uh, and you did mention about term life insurance as well. And on this podcast, we have spoken a lot about whole life. So, who are good candidates for term, whole life, and IUL? Right? Because some people, right, as you said, invest, you buy term and invest the rest. So most of them, when I talk to my friends, they're like, oh yeah, I can get term for 40, $50 a month. Why would I spend 300, 400, 500, or sometimes it's more than that if you
True.
want, like in whole life insurance, if you will, if you want that additional cash value, right?
Right.
So who are good candidates, or who should go for term only and whole life or IUL?
Sure. Uh, As a rule of thumb, and how do I decide this? See, for my client, I sit with them and I create something called financial lifestyle strategy, where
Okay.
we gather the data and we put our minds to it and show them and prove them where would you be beneficial, what would you be doing, and what would work better for you. But as a general rule of thumb, Alpesh, what I would say is for your temporary responsibilities. Okay, what are the temporary responsibilities? Debt. If you have a rental
Right.
property, if you have car loans, credit card loans, any debt, student loans, right? That's your debt, but that's temporary. There is an end date to it, right? You should be done 15. Take the commercial mortgage, 15 years, right? For those things, the debt, you should buy a temporary coverage. You don't need permanent life insurance for that. The second
Yes.
thing is mortgage, your house mortgage. I call it as a mortgage protection plans. A lot of people don't have it. For your mortgage,
Yeah.
if you have $500,000 or whatever, you bought a house, unless you pay it off, it doesn't belong to you. So
Nope.
if you pass away, you need to have at least that much term insurance, 30 years, that's it, right? After
Yeah.
30 years, you won't have mortgage. But the good thing about term insurance is if you happen to cut your mortgage in half, if you happen to pay it sooner, guess what? Stop the term insurance
Yeah.
payments, coverage is gone. The third thing I would say is education funding for kids. People do 529s and education plans because they want to pay for their kids' education. If unfortunately something happens to me, right, before my kids go to the school, and I want to pay for their college education, hey, $200,000, $300,000 worth of term insurance by the time they turn 22, I should have it. But that's temporary need. Now, the fourth thing is a little debatable, what I call it as an income replacement.
Yeah.
Okay. What is income replacement? Hey, I'm the head of the household. I go to work every day. One day I go to work. If I never come back, who's going to replace my income? And that's why the company, the employers give you the coverage from the job, right? Which is,
Yes. Yeah.
I don't know, 2 times or 3 times of your salary.
Salary. Yep.
So that is for the income replacement. Now that is also, if you ask me, hey, for how long you're going to work? Maybe up to the age of 65.
Mm-hmm.
Have another term for that. So typically, when you need more death benefit, buy a term because it's cheaper. It's
Yes.
affordable, right?
And you can
The
cancel.
underwriting could be favorable there, and you
Yeah.
can cancel exactly.
Exactly.
See,
Yeah.
I have many clients who are on a work visa here. They come here and they say, you know what, Prashant, I don't know for how long I'm gonna stay here.
Right.
Why do I need a coverage? I said, listen, you don't need a visa to die. You need a visa to come here. You don't need a visa to die. If you
Yeah.
die tomorrow,
Yeah.
who's going to
You.
take care of the
Yeah.
family? So get a term insurance if you happen to go back. If you want to cancel it, cancel it. Or
Yes.
the term insurance today is so cheap, Alpesh, you can continue to pay it
Correct.
from a different country,
And you're covered. Yeah.
right? So anyhow, so those are the people who would be fit for the term plans. Now for the whole life and IUL, right? So whole life, I love that product. Many companies who have been in the market for 100+ years, they sell that product.
Right.
Amazing product, but it's an old product. Okay,
Mm-hmm.
it was invented back in, I don't know, 60s or 70s. It's a great product. You have permanent life insurance. You have guaranteed death benefit up to the age of 100.
Yeah.
So if your need requires you to have that, go for a whole life. Who would be the candidates? If you have a state, and if your kids are going to get into the trap of estate taxes tomorrow, you need to have coverage as long as you
Oh
live,
yes.
right? So if you're worried about the estate planning, you need to have a coverage that is guaranteed, rain or shine, for the rest of your life. Or if you're someone who wants to make sure that, a lot of people believe in the causes like me, I believe in my causes for charity and things. So I've seen people who want to leave something behind for a temple, for a church, for their grandchild, who knows, right?
Uh-huh.
So for that, you need to have, you absolutely have to have a coverage as long as you live. So
Yeah.
for those people, a guaranteed life insurance as long as they live is important. So they may be good candidates for whole life because it's a permanent life plan,
Right.
guaranteed up to at least age of 100.
Yeah. Yeah.
Now the IUL or anything other than a whole life policy, those policies would be fit for someone who understands the life insurance as a retirement plan. Okay, there is a
Yeah.
terminology, LIRP, life insurance retirement planning.
Remember.
If someone's looking for that, because hey, you get tax advantage, you're deferring the taxes, plus you're growing your cash value, you have better potential to earn interest, because typically in a whole life product, I believe there are fixed interests, right? But in an
Uh-huh.
IUL
Yeah.
scenario, you get a variable interest and you have a guaranteed floor, or you have a guaranteed minimum interest. So if someone wants to use it as a LIRP, or one company calls it as LIFT, LIFT, life insurance as a financial tool. So if a client understands that, they should go for the IULs.
Oh, that's a great explanation. And by the way, I have all three of them.
There you go.
um, do you recommend one strategy or another, especially comparing dividend-paying whole life insurance versus IUL?
Uh, I wouldn't necessarily compare those things because, see, dividends, first of all these whole life companies have been paying dividends every single year. If you look at
Yes.
the track records,
Yeah,
they pay.
especially I was looking at Penn Mutual and Mass Mutual. I have a policy with Penn Mutual, and they're 115, 120 years.
Yeah, yeah,
That's a
it's a
long
solid.
time.
They have been paying dividends every year. Can you imagine that?
Yes,
That's
yeah.
solid history. But you need to look at how much of dividend. And the second thing you need to look at is what is your dividend doing? Okay.
Yeah.
Many people, and again, these are the things that you need to be careful as a client when you're purchasing a life insurance contract. Many contracts I look at, there's something called as paid up edition.
Yep.
Okay, paid up edition. So if let's say one of our listeners has a whole life policy, I would want you to look at your policy and think, when was the last time you received a check with the dividends? Let me ask you, Alpesh, when was the last time you received a check?
No, never.
So
I
where is
don't
the
remember.
dividend going?
It's going back to the policy.
Exactly. So that's why I may not compare it directly, because there's
Right.
a edition option. So sometimes the option is chosen where the dividend purchases extra life insurance for you,
Yep.
right? Or sometimes it goes back into your cash value, or sometimes it is utilized to pay your premiums. So based on how that is used will be the importance of the advantage of your dividend. Versus in IUL, there may not be dividends. There may be multipliers, there may be bonuses, but in an IUL, the interest that you earn is added to your cash value, right? The
Yeah.
second thing, and nothing to do with the dividends, but there's something called as a level death benefit versus increasing death benefit. What happens when you have a level death benefit, which most of the whole life policies I see that happens, is if you have cash value and you have a death benefit. So let's say you have $500,000 worth of death benefit and you have $100,000 worth of cash value. If you have level death benefit, that cash value does not belong to your beneficiaries.
Right.
Right? So that may be another thing you need to look at. If you're getting dividends, what are your dividends doing for you? Are those going to be paid out to your beneficiaries? Are those going to be paid out to you? Or what is it doing? Versus a policy where you may have increasing death benefit. So whatever interest you're earning, bonuses you're earning, all that can be lumped with your death benefit, and that can go to the beneficiaries. But if you ask me, what would you pick, one over the other? No, it depends on what you want to do, right? At the end of the day, it's the client's needs is what we need to address.
That's awesome. No, this was a great beginner's course for us on IUL. Let's take a quick break.
Definitely.
Welcome back to Wealth Matters Podcast. I'm chatting with Prashant on life insurance and especially IUL, Index Universal Life Insurance. Prashant, this second part of my podcast is a fire round where I ask every guest same questions every week, so that I can compile and understand what everyone thinks of what's going on in the current environment, as well as may have some tools or anything else to give it to my listeners, right? So first question, what do you see would be the impact of COVID-19 on real estate and stock market? Or have you already seen the impact and maybe we are back to normal?
Yeah, I've personally seen the impact, and when it comes to such things, I always depend on the professionals in that domain, right? So I do have my real estate properties. I do have a realtor that I highly respect, because he has been the source of information for me for many years now. According to him, what he's seeing is the rates, and I live in Georgia, so the rates I'm seeing are plateaued. Okay, it was going up. The rates are plateaued. According to him and his, I mean, he works with a big realty. According to them, the prices are going to fall down.
Okay.
The other thing is, because of the job situations, the rents are not collected as frequently as they were. You can't do anything about it.
Yes.
So it is hampered. It is.
And that we will see in future, not now, because right now government is paying forbearance and whatnot, but
Right.
should see the impact in 6 months.
Yeah, so
Okay.
the ripple is going to be there. Now, on the
Right.
stock market, on the other hand, again, I have someone who's my wealth manager, and he sends the reports. He actually rings the opening and closing bells on the New York Stock Exchange. Very, very competent person, has been doing it for 38 years now. What he said is it's a bell curve, right? So the corona cases and the job losses, it's going to be a bell curve. So as the states open now, as the states are slowly opening, the stock market has seen maybe one of the worst things ever, right? Look at the S&P crash and all those things. So it has impacted, but there's going to be a slow recovery. It fell down pretty rapidly, but the recovery is going to be slow. But when it comes to investing, if you know what stocks to pick, if you know what industries to follow, great buying opportunity.
Yeah.
Right?
Would you be changing any business or investment strategy after coronavirus?
I will be, yes.
How?
Buying opportunities, right?
No, that's good. Favorite real estate or finance or any other book?
Favorite book. I'm a big fan of Sir John Maxwell. His books have changed my life completely. I'm also following Darren Hardy. So to point
Yes.
out one book, I'll tell you, The Compound Effect.
Oh, yes.
That book has
That's a
changed.
great book.
It has changed the way I live, honestly. In the real estate, I was very intrigued with one of the books from Grant Cardone, who says, be obsessed or be average. That's another thing. And the last one I will say, especially on the, since we are talking about IUL, there's an author called Patrick Kelly. And Patrick has written many, many books, especially the one that I would quote here is The Retirement Miracle, or The Tax-Free Retirement. Both books are phenomenal when it comes to understanding that domain and understanding why and how life insurance can be used as a investment vehicle.
Okay, I got to read those then, because I have read The Compound Effect. It's amazing book.
Yeah.
How do you give back?
The most tangible way of giving back for me is I operate as an open model. I give the opportunity to people to work with me if someone's looking for an opportunity, because someone gave me that opportunity. It changed my life. It changed my finances. Because the best gift you can give to anyone is a hope, right? A hope of doing better, a hope of doing something for themselves and becoming better. So what I do is I offer the opportunity to work with me. They can work with me on a contract basis, on a commissions basis. I teach them, I coach them, I guide them, and see if this is something they would like to do. Because a lot of times people don't get the guidance in life. That's the most tangible way. And of course, I have my causes that I believe in. Money can only do certain things, but as a person, Neil Armstrong had said, right, whatever you do is a small step for a man, but a big step for a mankind. You need to look at those aspects of the life. I mean, you may be doing a small thing in today, but that may create a huge effect or impact on the humanity or in people's lives.
That's awesome. Thank you so much, Prashant. How can my listeners reach out to you?
Well, I can be reached out on my email, so I'm sure you have my email address. They can go to my website. I have a full domain, but you can go to upfs.com, Uptick Financial Services, so upfs.com, and you can contact me directly from our contact us page, and I would love to assist you.
Okay, thank you so much, Prashant. Have a great day.
Well, thank you for the opportunity to talk on your podcast, Apesh. I appreciate that.